The first 50 days of the Trump administration have seen stocks suffer their worst start to a presidential term since 2009, when Obama first entered the Oval Office. The ongoing market volatility is all thanks to the drama unfolding over President Trump's trade war, with tariff exemptions and related headlines adding to investor anxiety over the economy. And Trump declined to rule out a recession when speaking to Fox Business anchor Maria Bartiromo on March 9th.
There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
So, will the back and forth on trade policy chill the economy? That all depends on consumer spending, says Barron senior economics writer Megan Leonhardt, who joins us now to break down the latest on Trump's tariff plans. So, Megan, it's great to have you here. And where do we currently stand with tariffs on China, Mexico, and Canada?
It's been a really interesting month, obviously, and lots of news. It feels like on a day-to-day basis, the situation is constantly shifting. So, currently, as of March 13th, where we're at the moment is that, the Chinese tariffs have been rolled out. So obviously, that is an extensive and certainly, very big shift in terms of the magnitude of tariffs that are now being actually levied against goods that are coming to the US currently. Now, when it comes to the Canada-Mexico tariffs, things are a little bit more complicated. So obviously, beginning of March, we had, the initial announcement that both countries were going to get 25% tariffs. And then, President Trump did walk that back a little bit. And I want to stress the a little bit here because while there are a number of carve-outs that are taking place because until April 2nd, anything that is covered by the USMCA deal is not being tariffed at the 25%. But I've talked to a number of economists over the last couple of days, and they have said that actually it could be as much as $5 trillion worth of goods that are being tariffed at that 25% rate coming in from Canada and Mexico. So those are actually, big tariff changes that are already in effect. And then, of course, we did see that on March 12th, the steel and aluminum tariffs were increased to 25% as well, and that's against all global countries. And so there were some retaliatory moves made because of that, both from Canada as well as the EU. And that has spurred some additional conversation by the Trump administration that we could actually see a number of tariffs being put into effect on EU goods, on additional goods from Canada in the coming days. Things like, wine and alcoholic drinks and beverages from Europe, certainly, potentially part of that. President Trump announcing and threatening that there could be as much as 200% tariffs on those goods as a retaliation for the retaliation of some of those steel and aluminum tariffs. So again, very fluid situation, and it is creating a decent amount of uncertainty, not only for markets, remember, but also for businesses and consumers as well, who are having trouble figuring out exactly what the outlook looks like and how they are going to respond and plan accordingly.
And we've seen this uncertainty play out in the markets, as you say. And President Trump has made several comments recently that hint the economy will experience what he says is maybe a little disturbance or adjustment period due to this trade policy. So, what is the anticipated impact as this all plays out?
The anticipated impact is definitely still in the flux period. So we don't have a complete picture of what many of these policies really will come down to when it comes to the details, and of course, how long they will be in place. I think that that's really the key thing here. If we do see, some of these tariffs being rescinded, that could obviously change the picture. But as of now, we do have a number of estimates that have been put forward that the policies in place as of current, when it comes to China, Canada, and Mexico, that could be, as much as, a percentage hit to GDP from what it would otherwise be. And then, of course, there is the idea that we are also going to see some inflationary impact when we do have the tariffs being put on a number of goods coming across our border. And keep in mind that it's not just finished goods that these tariffs are being put on, it's all the inputs that US manufacturers and businesses do use in order to make their own materials and products. So many times think the car industry is a great example that, it may be one of those situations where we may not see tariffs on the final vehicle, or we may, but it's all the pieces, parts that do make up that vehicle that could, again, bit by bit, be more expensive down the line. And of course, the indirect effects of this could potentially be even more of a big magnitude on the US economy. Keep in mind that, consumer spending is just about 70% of economic growth right now in this country. And so when you do have these very uncertain times, you can have a sort of sentiment slide, if you will, and we're already starting to see that. Now, we have sort of situated ourselves where sentiment doesn't always mean that the action is going to be taken. Keep in mind that sentiment readings were pretty low during the Biden administration, for example, and yet consumer spending was very, very robust. So the correlation between sentiment and action hasn't exactly held up in recent years. That doesn't mean going forward, however, that consumers are going to be spending in a gangbusters fashion. We also have to take into effect that business confidence has also taken a hit. We did see the NFIB survey of small businesses, for example. They had their second consecutive month of a downward slide in their confidence. And, even bigger industries, the Conference Board, others have sort of indicated that things like, capital expenditure planning has been a little bit more muted in the first couple of months of the year.
And you talked about, some of these impacts to growth and the inflationary measures. We saw the week of March 10th, inflation cooled a little bit. But when do you think we might see this turn up in those some of those data numbers that come out, and what could investors expect there?
It's interesting. You did point out that we haven't seen a ton of impact in the so-called hard data yet when it comes to the impacts of the Trump administration policies. And of course, I'm not just talking about tariffs here. I'm also talking about things like immigration, which could obviously hit labor conditions. So, it is sort of interesting. We really only have January and February to go off of. We don't even have all the data for February at this point, but it is looking like a fairly stable environment. Of course, that could change pretty quickly. When it comes to when we will start to see the impacts, of course, we did get the consumer price index report out on March 12th. It was a fairly benign report, which was nice to see, but we have sort of some subtle indications that those Chinese tariffs are already starting to slip into the data. We could actually see a more of an uptick as early as March, and certainly by May we should see the effects pretty stridently in this data. So it is one of those situations where this is going to come pretty quickly. On the labor side of the equation, we obviously saw in the February jobs report that, federal employment levels did actually fall for the first time. And that was pretty significant. And obviously we are expecting that sort of government sector to really be hit hard in the coming months. Whether the private sector can make up the difference or not remains to be seen, particularly given the sort of crackdown on immigration policy.
And I think the big concern over all of this is stagflation. So, is there any indication on how the Fed is looking at this, or how they might react with interest rate cuts if we do see inflation starting to tick back up?
Well, the Fed is certainly going to be under pressure, and I think that that is a pretty benign statement at this point. It certainly isn't controversial. So typically, economists tend to look through the effects of tariffs in particular because they typically result in about a one-time price level adjustment. But the magnitude, as well as the sort of tit-for-tat tariff policy that we're seeing take place right now, could really shift the narrative there. And what we could be looking at, as you pointed out, is a stagflationary environment where we have higher prices and lower growth. And that can be really tricky for the Fed, remember, because federal officials have really been trying to get inflation back down to that 2% target. And if you look at their, gauge that they prefer, it is about 2.5% of the latest, numbers there. Of course, we're going to get some updates in the coming months, but that is kind of an interesting aspect. We're not quite at 2%. And so I think Fed officials are very concerned about additional cuts being, really needed because we may have deterioration in the labor market, for example, or we may have deterioration in economic growth, but that increase in inflation could really make it very difficult to navigate that environment for Fed officials.
So, looking at the other side of this, if we do get more jobs domestically because of onshoring of manufacturing, that could certainly take a while. But what impact would or could that have on the picture here?
It's really interesting. I've heard a lot of the discussions from Trump officials and from the Trump administration around these big ideas that we are going to have a manufacturing boom. We're going to do a lot of onshoring. We're going to bring jobs back to the United States. But the problem is that I think reshoring and onshoring are not quite the way that we should be looking at this. We are not just going to hire a bunch of workers at existing facilities and really make the boom happen that way. Unfortunately, in order to be competitive on the global stage, and quite frankly, even domestically, we are going to have to start from scratch in some respects to our manufacturing sector. We really need automation in many respects in order to keep labor costs low, in order to keep productivity up, so that the profit margins of the nation's biggest manufacturers do not crumble. And in that case, that may not actually result in that many new jobs. And so, what we're looking for in many cases is actually high tech jobs in manufacturing, high tech jobs in construction. And that, of course, requires a decent amount of education, re education, all of that good stuff. And so, this is a really, almost multi generation plan that the Trump administration is attempting to enact. And I'm not sure that the US economy has that much time in order to, have this sort of detox period that many of the officials are really touting at this point. Additionally, you have to keep in mind that we haven't even seen the full effect of the retaliation from other countries. And in the past, it's really hit sectors like agriculture and many of the sort of industries that are very prevalent in the middle of the country, where also this manufacturing is attempting to take place and the onshoring is attempting to take place. So I just don't see how this is all going to work out in this beautiful fashion that's going to be a very smooth process. I think there's going to be a lot of bumps along the way. And unfortunately, one of those big bumps could be the US economy.
And you mentioned here and in your reporting that a lot of this will have to do with the strength of that consumer spending. You said sentiment's already starting to slide, but there's also a concern that consumers are just maxed out. Literally, the amount of debt people are carrying might make it difficult for spending levels to stay strong. So, what are some metrics there that investors should be paying attention to?
I do think that the health of the US consumer is one of the key factors here. And of course, we have seen delinquencies rising, we have seen credit levels rising. Not to extraordinarily worrying levels yet, but any rise is something to keep an eye on. So I think continuing to watch the ability for consumers to pay down their debt, to pay off their debt, to make timely payments, definitely key here. But additionally, I think we need to look at not only the spending levels, so things like retail sales reports and whatnot in the coming months are going to be hugely critical, but also where people are spending their money. I think discretionary spending is something that we're really going to have to watch closely. In fact, things like restaurant spending, which, you think, oh, well, that's, just a small portion of the pie, but it's something that people can pull back on quickly and, have relative flexibility to do so. So if we do start seeing, a real pullback in this situation, I think that that is when we're going to start to maybe potentially have that transition from low sentiment to also then a pullback in action. And so that's something that I'm watching very closely. It'll be interesting to see. We've already sort of seen in some of the initial reports from February that card spending, credit card spending, and debit card spending is actually down in February. And, again, some seasonal factors there, but that's a little bit of a, potential yellow flag here.
As you said, this is a very fluid situation, and you mentioned that April 2nd date that's out there on the horizon. So, what do you suggest, or what is your guidance then for investors to keep in mind as this tariff situation unfolds?
I think investors need to be patient, but also be careful about overreacting to one specific data point. We're going to have a number of economic releases in the coming weeks that may look pretty unpleasant on the surface, But, like Fed officials are constantly telling us not to overreact to one data point, we do somewhat need to see a little bit of a trend here in order to make those choices. Now, that can be a little bit tricky for investors who do need to move quickly if the situation does deteriorate. But I think being able to be, pretty nimble, pretty flexible, and if you do have, real concerns, or, you really do have goals or ambitions, over the next couple months, maybe it is, worth sitting there and reevaluating where you have your investments and how well you're positioned in order to meet any kind of market headwinds. Obviously, the short-term effects of all this is increased volatility, increased uncertainty, and, I think it's just a matter of being prepared for it at this point. Of course, that doesn't rule out that we may be looking at a slowdown year. Certainly, that was in the cards already for the US this year. We were going to have a slower year than 2024, but if that slowdown turns into, rapid deterioration, I think that's where we have to start moving. Of course, keep in mind that, some of this data is pretty backward looking. So definitely, be looking for some of those forward looking data points. Indeed's job postings, for example, is a good forward indicator for the labor conditions. And as I said, those credit card spending can be a little bit more real time than some of the census and, data that we get from the Bureau of Economic Analysis.
Megan, thanks for your insights today. Lots of great information. We really appreciate it.
Thank you.